Hello and welcome everyone to another episode of the Forever Cash Life Real Estate Podcast with yours truly, Jack Bosch. And today we are going to talk about real estate taxes. Ooh, that's going to be fun. Actually, it's one of the most important subjects that you can talk about because why work so hard if then giving everything to Uncle Sam? So with that said, we have a very special guest about that, Rebecca Walser, and we're going to get started in just a second.
Welcome to the Forever Cash Life Real Estate Investing Podcast with your hosts, Jack and Michelle Bosch. Together, let's uncover the secrets to building true wealth through real estate and living a purpose-driven life.
All right, so here we are. So I'm super excited to have our guest here. Rebecca, how are you doing today?
I'm great, Jack. Thanks for having me.
Wonderful, wonderful. I'm super glad to have you. It took us a little bit to get this worked out. Had a couple of delays in setting this up. Mostly from my side, I have to reschedule, so I apologize for that, but we got it done. So now, very quickly, a few words about Rebecca here. Rebecca is a tax attorney, a certified financial planner, and an experienced wealth strategist, also a best-selling author. And with all of that, she's really uniquely qualified to assess, structure, and implement the best income maximization and wealth maximization, tax mitigation, tax minimization, and optimal legacy strategies for her clients. So now we are super excited to talk to you about that. I mean, she has 3 degrees, working on a 4th degree right now, right? So it's like addicted to education, as I'm too. I just can't go to college back anymore. Although I really enjoyed my college life. I went there for like 7 years straight, and to get my degrees and so on. So she worked also at worked in finance with PricewaterhouseCoopers, led the global networking division of IBM. She worked for acquired then by AT&T. I mean, she spearheads a national practice with clients around the country. I mean, we could go on and on and on and on. She has, you have a podcast too, right? Crashes and Taxes, and has been named both 2018-19 top 100 US advisors by Investopedia. I mean, we can go on and on and on and on. So Rebecca, just instead of me singing your praises, give us a little bit update about you, what do you love, what you specialize on, and a little bit of your backstory.
Yes, absolutely. Thanks, Jack. So my undergrad was in finance. So I started with PW and my boss was in London. So I did a lot of international travel for 5 years. I was a little bit burnt out. We used to call it flying across the pond. I used to fly across the pond, which you know what I mean, flying across the Atlantic between here and there. And my last trip, I flew across on a Monday night, landed on a Tuesday morning, took the train from Gatwick straight into the office, worked all day, Tuesday, Wednesday, Thursday till 2 a.m. and got on a flight home on Friday, was home in the US by the afternoon of Friday and said, this was my last trip. This is dumb. Who goes over there across to Europe to work for 2.5 days? It was crazy. So I did that for quite a while. Then like you said, I went on to IBM, AT&T, and I actually did also work in real estate finance. So I'm very familiar with the real estate background in the world. After doing finance for years and years, I decided, you know what? I keep running up against taxation. I'm going to go back to law school or back to school, become a lawyer, and specifically become a tax lawyer. So I went to University of Florida and got my law degree. And then I went on to NYU in New York and got my specialty in taxation. And so those are the 3 degrees I already have. I'm currently working on an international MBA with the London School of Economics, partner and concert with NYU and HEC, which is a Paris location. So that's what my background is. And my passion, I would say, is for the last 7 years, I've had my own practice, and I've really just been super obsessed with helping people understand how tax imports into your wealth, and that you can have the greatest investment in the world, but if it's going to be in a taxable, container, if you will, then we have to do some work because we're approaching a new era of time, Jack, and that's what's happening to really change everything. And specifically, real estate's going to be quite impacted, and that's what I really want to talk about with you today.
Wonderful. Let's talk about that. So first of all, congratulations to this degree. So that is very, very impressive. I know how it also feels to work like 60 hours in what feels like 3 days or so. Very similar. I just didn't have to fly across the pond. I had to once, But for 5 years, I had a job for 100% travel. And that was so painful that I would fly out Monday morning, land somewhere in Wisconsin and work from by the time I get there, it's or actually for Wisconsin, I had to leave Sunday night, get there Monday, overnight flight, work all day until 10 p.m., and then do that again and again and fly back Friday night with 70 hours of work and just sleep through the weekend. And it got me my green card. That was the purpose of it. But it also made us so desperate to do something else that we found real estate. So it was a blessing in disguise, but just as it seemed to have been for you too, that it was a blessing in disguise. I'm not doing that anymore. And all of that grew something, an entire business that is now flourishing. So wonderful. Yeah. So let's talk about taxes though.
Yeah,
so
absolutely.
What do you see coming? In the pre-interview, we talked about a little bit that you see a whole bunch of tax changes coming that if they come to in place, we want to prepare for. So let's dive right into it. Let's talk about that. What do you see coming?
Jack. So the first thing for your listeners to know is that why is everything changing? What's happening now in 2020 and really 2020 to 2030, this decade? This is the sea change decade that we've ever had in the history of America, with the exception of the American Revolution and, all of those kinds of things that are, from the beginning of our country. I'm talking about since we've been established as the country, this is the most changed decade that we have ever had or probably ever will have. And so what's happening? So the reason that everything is starting to change in 2020, 2030 is between 1946 and 1964, we had 75 million baby boomers born within that period of time. And if you look at the actual birth dates, most of those people, about more than 60% of all of those births are concentrated in about a 6-year window. So what's happening is of these 75 million people that are born, 70 million are still with us. And a lot of those 70 million are still working in some capacity. They're still actually working. So if you look at the boomers that are going to be retiring, you'll see that between 2020 and 2030, everyone retires. The last boomer retires or reaches what we call FRA, full retirement age, by the year 2030. So that's why it's this decade. And if you look at the impact of this, is the largest, and I mean in the history of recorded time, this is the largest demographic shift of millions of people that are currently gainfully employed and paying what we call our payroll taxes. So our FICA taxes that support Social Security and Medicare, our payroll taxes support Social Security and Medicare. Those 70 million people are currently in the system working, paying those payroll taxes. And over this next 10 years, they're going to retire, which means they're going to stop paying those payroll taxes. And then they rightfully are themselves going to go on to Social Security and Medicare. So when you think about 70 million people that are currently in the people that are paying, they're going to retire and then they're going to rightfully go on to Social Security and Medicare. So it's a swing of about 140 million people in the wrong direction because they're going to extract from paying and then they're going to rightfully pick up and start going on to benefits. And if you pinpoint what the problem years are, if you look at by the end of 2021, you haven't felt anything yet, Jack, and nor will you feel anything for a while, because we will only have 30% of our boomers retired by the end of next year, 2021. The real problem, what I call the demarcation line in the sand for the United States of America, is beginning in 2022, because once you hit 2022 through 2026, that 5-year period of time, you have 50 million people retiring in just 5 years, which has never happened before in the history of America. And that is a massive crunch from a financial perspective. And so what has happened is the government has been aware. If you've ever heard, and I'm sure that your listeners have heard of the phrase kicking the can down the road. So
right.
We've known since 65. Social Security was signed by FDR in 35. Medicare came out in 65, 30 years later. We've really known since 65 that when we get to this decade, 2020 to 2030, and all these boomers are retiring, we're going to have massive cash problems in this country. So in 2008, the CBO, which is the Congressional Budget Office, did a mathematical analysis of the impact of the retirement of the baby boomers on Social Security, Medicare, and Medicaid, which are our three big federal, sort of social safety net systems. And the CBO concluded two things very clearly from this report in May of 2008. And the first conclusion was, number one, benefits must be cut. So if you think that you're going to have this great portfolio and $100,000 of, income that you're taking from your IRA, maybe your real estate portfolio cash flow, and then you're also going to get your full Social Security benefit, the CBO clearly came out and said, no, that's not going to happen. You're going to have your benefit cut, or what we call means tested, for the other taxable income that you have. But the second thing that they came out with, which is the huge thing that is just life altering, is they said taxes must go up. And they actually gave us projections. And so they said that our 10% lowest rate right now, 10%, which is the entry level rate, right? That is projected to go to 25%. And they told us that the 25% middle class tax rate is projected to go to 63%. And our top rate is projected to go to 88%. So what we've got is more of a European shift for taxation that they're very used to, as you're well aware, Jack. They're used to that kind of taxation. America is not. We actually did have, and if you have my book on 117 of my book, I talk about the history of tax rates. We had the top tax rate on average before 87 and Reagan's tax reform. We had it at 61%, because for most of our history, before Nixon took us completely off the gold standard, we had to collect the revenue that we were spending because we were on a gold standard. So we didn't have the ability to debt finance. Once we came off the gold standard and fully in 76 under Nixon, and then Reagan cut our tax rates in 87, we had tax rates go to the top rate was 28%. We had the lowest taxes, but what's happened since is we've just debt financed everything. When Reagan first took office, we didn't even have $1 trillion of debt in 1980. It took all the way to October of 80 for us to get to $1 trillion of debt. So now what we've done is we've had extremely low tax rates that we don't afford with our tax revenue. We just keep the tax rates low, and we've just been debt financing everything since the 87. And that's why we have nearly $30 trillion of federal debt. And so now you have this perfect storm of $30 trillion of federal debt colliding with the retirement of the baby boomers. And there's nothing that can happen now mathematically except for cutting benefits and massive raising of taxation.
Right. So actually, this is exactly what I've been telling people when we do live events up from stage. I was like, guys, the demographics of the United States is already decided. All the people that will pay your and our retirement have already been born, right? So it's like they know all the retirees when they're going to go in there. Now, having said that, I agree with you. And I would say, like, all you need to look at what needs to happen with taxes. While I'm not sure if I agree to the 60% and all these kind of high tax rates, they might kick the can further down the road by not putting it at that high. But it's the direction of what you're saying is absolutely 100% correct, because we're already seeing it. There is a country in the world, a civilized first world country, that's already 10 years ahead of the United States in demographic. And that country happens to be Germany, right? So it happens to be Germany. Germany's already aging, well, rapidly, but in the sense because of the birth rates and things like that. It's already, old age poverty is becoming a item. I still subscribed online to a couple of German newspapers that I read occasionally, and old age poverty is something that is absolutely prevalent now in the luxury country of Germany, right? There is high taxes. There's a lot of Germans that come to the US to invest in our land flipping programs, because in Germany, if you make something like $70,000, you're already at the tax rate of where you're paying 55% of your income in taxes. Yes. And that's, in addition, there's all kinds of additional taxes that Absolutely. You pay. So you're already at almost 60% of your income in taxes. Yep. Only if you're not even making 100 grand yet, and You're already at the 55-60% rate. So this, and I also agree with you that there's no way to sustain what the country is doing right now, right? Yeah. There's no way to sustain. It doesn't matter. This is not Trump or
right. Absolutely.
or Obama or whatever it is. This is not. It has nothing to do with that. It is a pure. You cannot, as a country, have a $1 trillion deficit, or in 2020, a $3 trillion deficit
Right.
on an ongoing basis,
Right.
on an ongoing basis, without at some point of time having to counterbalance that. And with the amount of retirees, which is to some degree, from my understanding at least somewhat counterbalanced with the insertion of a whole bunch of these young kids, whichever the generation is called, they're starting to hit the market in like 2021, 2022. So there's some new generation coming in, but still, I agree with you that 150 or 100 million people going into retirement, whatever the number was, in a short period of time is not something the world has ever seen.
Right.
So yes, we know, and I keep saying that at the live events that we do, if you're in your 40s, 50s, you cannot rely on Social Security as your item. Now, it's not going to go away, because that will create civil war if it goes away. So because all these older generations there, I mean, I'm 50. I'm an older generation now, I guess, right? But everyone that is going to retire in the next 15, 20, 30 years is not financially prepared to live without Social Security.
Yeah,
so
right.
so the politicians are they're gonna keep Social Security in place. But in order to keep it in place, there's only two ways to do this: print more money, inflation, or raise taxes. And probably, my opinion is probably both is going to happen.
Yeah.
So what that means is really you got to put the pedal to the metal to create your financial fortress right now by playing offense, meaning making more money now, going a full-blown attack mode on finding a method to bring in a lot of cash, and playing defense and shielding that money from the taxes to the highest possible degree so that the government doesn't take it all. So you know which method I'm propagating to the listeners here, or audience. You know which method I'm propagating for you to take the offense, obviously your land flipping technique. Rebecca, I'm curious to see what your thoughts are on the tax attorney side of things, on the wealth preservation, tax minimization kind of side. What does somebody do in order to be prepared for that world?
Yeah, that's the $1 million question, Jack. And so specifically with real estate, I think we should really look at how real estate is expected to be impacted. But let me just go back really fast to one thing you said about the new people that are coming in to replace the baby boomers, because that's we're really talking about, I'm Gen X, like you are. We're the middle, like in the sandwich generation. Then we've got Gen Y, which is the millennials, right? They're already all in the workforce, because right. Gen Z, which is what I call the last generation, but they're called Zoomers actually for some crazy reason. I'm not sure why. The Zoomers, the interesting thing about this Gen Z is that a lot of them are already in the actual workforce. But what we're finding as a trend is that traditional jobs that have W-2 income are becoming the less frequent. There's certainly nowhere near the frequency of people that are retiring. So they're at the top of their game as a baby boomer, and they're retiring from their W-2 job, and they're being replaced. And how are they being replaced? So I don't know if you're familiar or if you follow anything with the law, but in California, they did an AB5. They did AB5 this past year because they wanted to capture all of the independent contractors who were not paying payroll taxes or were not paying state income taxes to the state of California. So it's basically a reclassification of independent contractors to W-2 employees so they can purposely collect their state income taxes. And one of the Biden proposals is to bring an AB5 to the nation so that you'd basically eliminate independent contractors and everybody would be some kind of W-2 employee, because they realize that as independent contractors, people are able to get a 1099, write off expenses, and then really not pay taxes on their earnings, but pay taxes on a much reduced amount, which is the way you are in business. So that's got a lot of changes coming there. But what's been really fascinating for me, because I have a lot of real estate investors.
Basically, what you're saying is that I know California has been doing that, particularly it became famous with Uber and so on. But what you're saying is that the independent of this going through or not, and we don't want to get into politics, is
right.
Is the Zoomers are coming in not with a typical income that a new generation comes in, but actually with at least taxable with a lower income. So they're not replacing them. Well, they wouldn't be expected to replace them right away. It takes years to reach the income potential.
Yeah.
but they're not even on par with the Generation Y, with the millennials
Traditional.
on what with the traditional amounts of incomes, because they're
Exactly.
choosing to do more of the gig economy where they can write off a whole bunch more. So their taxable income is lower. Therefore, their revenues that are being replaced are not the same. They're actually much lower revenues that are being replaced. Is that
Exactly. And it's beyond the gig economy. It's social influencers, it's YouTubers, it's all kinds of the new, what you do. You created your own podcast, you created your own empire, you teach people how to do land development, investment. It's all of those non-traditional roles that people are becoming more entrepreneurial, but because of that, they're less relative to going into a W-2 position, which is collecting those payroll taxes, which is what supports Social Security and Medicare. So yeah, we have got a lot of issues with the demographics. Exactly.
Okay, so then what does one do if you're aware of that? I mean, I always believe that there's good and bad information. You don't want to stay away from the bad information. You want to actually know the bad information just as much as the good information so you can prepare. One of the steps is accelerate your income potential right now while the taxes are low. And really put the pedal to the metal. Second kind of strategy is from a protection point of view. What do you? I mean, I know that's a big question to ask. What do you do?
It's great. It's great because it leads me to what I want to talk to you about specifically for your listeners, which is the real estate investors. Because I have real estate investors that have come to me over the years. And real estate from a tax law perspective has been extremely favored. In fact, I would probably call it the second most favored asset category in the tax code. There's one that's superior to that. But let's talk about how real estate is so tax favored right now under current tax policy. So it's very simple. You know the deal. I'm sure that it's something that you have taught to your people for a long time. You buy a property, and obviously this is once it's developed beyond the land, right? So we buy a property, and once it's been, developed and it's got a building on it, then we are renting it out, and we've got depreciation on that building that will basically offset to a large extent the rental income because it's a non-taxable, it's a non-cash actual expense, but it literally writes off our rental income. So real estate investors use the depreciation to get cash flow that is not fully taxable because of the depreciation expense. So that's the first positive, is that you're able to write off depreciation, a non-cash expense, against your income and not pay taxes. You fully then eventually depreciate down to a basis of zero that real estate property, and then maybe you sell it. So here comes the next real estate benefit. You sell it, you have 100% gain because you had zero basis at that time, but you don't pay tax on that gain because you 1031 exchange that gain into your next property. And you do this over and over and over so that you never pay tax on a gain. You just successively sell. You don't pay as much tax on the income as possible because of the depreciation. And then the final third and most favored tax status is what we call IRC section 1014. 1014 allows you at death to step up your portfolio of real estate to its then current fair market value to your heirs, which means they inherit it at fair market value and never pay tax on any gains. And so forth, you completely eroded and eliminated taxation from your real estate holdings throughout your lifetime, and it goes down to your children tax-free, stepped up, income tax-free. We're not talking about estate tax. That's a whole nother topic. So this has been the real estate game, and this is what makes real estate investors love real estate. And as well as a tax lawyer, we love it too, but it's under attack. And so let's look at what's coming. And I love presidential elections because new tax policy ideas are always promulgated out there, and they're not in law yet, but they're what is coming. They're always foretelling us what is coming. And unfortunately for real estate developers and real estate investors, we see 3 proposals that will completely change the taxation of real estate. And so I will walk you through those. First,
before you go,
yeah,
what you just described is 100% exactly what every smart real estate investor does. We're doing all three of those right now. I mean,
Yeah.
not the death one, obviously, but we have that in place. We have an estate plan in place that allows when we pass away for this to step up, if it's in law, and if it's, of course, if depending on what the law is at that point, because I'm planning to not die for the next 57 years, right? And I have a goal to make it to 107, right? I don't know why that number came up, but that's the number. But
I love it.
but still, at that point, whatever the law is the law. But obviously, you adjust your estate plans based on the law changes such that they're optimized to those law changes.
Right.
And but the other thing, 1031 exchanges, the depreciation, bonus depreciation, all these things is exactly what we have been preaching for a long time. You make your money with one method, you roll it over into other asset classes that have the depreciation and have the tax benefits. Then when you sell those assets, you 1031 exchange into the next asset, you delay your taxes, and under current law, you can literally delay taxes to your entire lifetime and potentially your children's entire lifetime if they learned this properly from you and do it things. So this is super exciting the way it currently is. Now let's talk about what happens if what's under attack. What are the three proposals? Because that's obviously important to know for everyone involved here.
Yeah. So what we'd like to do is, obviously we already know Trump's tax plan because we're under it, we're living it. So let's just talk about kind of the new proposals that were promulgated by the Democratic group. And it doesn't matter. It could have been a Democratic president in office and Republican ideas we'd be discussing. And it's just that's the kind of status right now. So let's talk about the proposals. Well, the first thing was Mike Bloomberg proposed the elimination of the 1031. So that's huge, right? Because if you do not have a methodology of rolling over a gain, then when you go to sell a property that has been fully depreciated, because remember, once we get to the fully depreciated status, we're paying tax on all of our dollars. We're not shielding our passive income anymore. Our rental income, we're not shielding from depreciation. So if we have a fully depreciated property and we need to sell it, well, if the 1031 isn't there, then we have to pay the gain. So we completely lose that. So that's a Mike Bloomberg proposal. The next proposal that we see that would definitely impact real estate investors is the elimination of capital gains taxes. And so there's different proposals out there. Joe Biden right now, obviously he's the front runner. His proposal is that once you make over 400,000, you would not have a reduced capital gains tax rate that's favorable. You would just be paying ordinary income taxes. But Jack, as a tax lawyer, I can tell you when anybody promulgates or brings forward a rule about only applying to people that make 400,000 and up, it's a very short order that rule is pushed down to the lower brackets. And especially with the amount of income pressure and tax pressure we're going to feel in this next decade, you can see that going down very quickly. So you're essentially talking about potentially the elimination of capital gains taxes and everything becoming ordinary income, which is a huge problem for all investors, not just real estate investors, but all investors that are getting any kind of passive income in the form of dividends, interest income. If you have note income on the real estate side, all of that being eliminated is a huge issue. So that's the second proposal. And then the third proposal was actually also a Biden proposal. In April of 2019, he came out before he was the nominee, and he proposed the elimination of the 1014 step up at death. And so I can tell you right now, the estate tax allows a person to pass over $11 million down to their next heir. So if you have a married couple, you're talking about $22 million. There's not a tax lawyer in the world that I know that believes that that is going to stand very much longer. In fact, it's due to sunset automatically at the end of 2025 and come back down to the level it was at before, which was really the $5 million that had been inflation adjusted over the years. So my personal belief is that after this decade, and we are to 2030, that you're going to see the estate tax limit per person come down to somewhere around $5 million per person, maybe even $2.5 million per person. I highly doubt.
Yeah, I highly doubt it. I 100% agree with you. That's the easy one to take because most people won't object to that because it won't affect most people. Right. So everyone is like, yeah, sure, no problem. Right.
Right.
So I'm never going to make $5 million. I'm never going to inherit $5 million to my kids. That is fine. However, listen, guys, by paying attention to this, I mean, this is a double-edged sword. I pride myself in being able to often like play devil's advocate and see both sides of it. So well, please take what I'm saying when you're listening, when you're watching this, listening to this. I'm not being pro or con of any of this. I'm just trying to look at this. I can understand why the government has to do certain things because the demographics that Rebecca just laid out are indisputable. Right? This is just what it is. This is the same that is in Germany. This is what we have been screaming off the rooftops for the last 10 years, doing live events in our live events when telling people, you got to take action right now because your Social Security is going to go lower, inflation is going to go probably up, and your tax is going to go up in order for it to pay for all of this because we know what Europe has to do, and your retirement age is probably also going to go up at some point of time. That's the other one. So we know this is going to happen. It's a demographical fact. So therefore, the government has to do something. Taxes will have to go up. The question is, which ones are they going to attack first? So, and here's the other thing. Prepare yourself for that with probably some advanced strategies and so on. But one of the things to think is, if you truly are investing in real estate, think about it. You only need 10 rental houses that you pay off over the next 10 years or 20 years. With inflation, they're going to be worth those $5 million. This is not out of reach for anyone who is actively in the real estate business, doing deals, building wealth, rolling the wealth over into improved assets, into cash flow property. You are all going to be in that bracket at that point of time. So it will affect you. So you want to pay attention to that. Yeah. Go ahead, though.
So Jack, the biggest one at the end was the elimination of the 1014 step up at death. So what that means is no longer, if you have a depreciated fully $5 million portfolio of different holdings, 10 properties, $5 million, and you pass and there's zero basis because you fully depreciate all those properties as you held them, then your family is going to inherit that $5 million and it's going to be taxable. So that's the third, kind of problem that we see coming for just pure real estate developers that haven't built what I call a parallel wealth track. So I just feel like people need to start understanding that the paradigm is shifting and that the era of Reagan's, 30 years of low taxes and great spending through debt only is really ending in this decade. And you are going to see America return to a more European style level of taxation. And we need to prepare for it. And it's not that real estate investors should abandon real estate. Not at all. I 100% agree with you. You should put the pedal to the metal and get the cash flow. But there is an asset class that is the most tax favored. I call it the golden child of the asset class code, really. And it is tax-free on an income perspective during your lifetime. And it is certainly transferable to your family income tax-free. And the estate tax, again, there's even a state tax plan you can do to make it tax-free. So I would just always encourage people, and I do this with all clients, whether they're real estate investors, whether they own a business, whether they're, working for Apple. I have a recent client, he's in his 30s. He's got $5 million of Apple stock because he just happened to be a super genius guy that was given a lot of stock options and did the right things with them. Whatever your situation, whatever your asset class is, whatever is your go-to for working and making money, don't abandon it. Understand what's coming and then build a parallel wealth track where you have some amount of income that will be able to be accessible during retirement, tax-free, so that as your other sources of income are taxed more and more and more egregiously, what we're not prepared for, what we're not preparing for, you have this other wealth class that you can pull money from. And it actually works in concert very well with real estate. I'm sure you've heard of it before, Jack. It's overfunded cash value life insurance. It is the most tax favored asset class. And there are a lot of policies that are designed to have really high cash levels. So you put money in, you pay a premium, you turn around and get most of that premium right back out to do your real estate investing. And you do that successfully over and over and over. And as long as you keep some money in that policy that's going to be able to grow for you, you can then access that money during retirement totally tax-free, not even reportable. So just build a parallel wealth track and be aware that everything that we're so useful and so take it for granted right now in real estate is changing.
Right. I also agree with that. And yes, so that's we had another guest speaking to the same subject not too long ago, and it's actually something we have now implemented ourselves also because for multiple reasons. Because first of all, to be able to have the cash working while you can pull it back out. Secondly, for it to be safe from creditors if anything ever happens.
Absolutely.
Next thing, it's safe from it's currently safe from taxes. Obviously, that could change too. But and then lastly, though, if you don't take all the money out and if it continues growing, for the same reason that you just mentioned, when you pass away or when I pass away, if there is a tax liability for our daughter to pay, she doesn't have to sell assets in order to do that. I remember when Pablo Picasso, the famous painter, died, he was obviously sitting on an entire workroom, an entire studio atelier full of Picasso pieces, right? Because he created them. Well, they were estimated to be worth something like $500 million.
Wow.
So he didn't leave that much cash behind. So his daughter, Paloma Picasso, actually had to sell some of their most treasured pieces in order to pay the tax bill. So she had to sell a third of her dad's art that she really wanted to keep in order to pay the tax bill so that she could keep the other three. Like if Picasso would have invested in something like that and she would have made $150 million, he certainly had the money for it because his pieces obviously sold for millions and millions of dollars. Then he would have perhaps had $150 million. I mean, that's a high number, but like would have had the money out of this insurance or the death benefit to pay the IRS off, or the Spanish or wherever he lives, I think Spain, the Spanish IRS off, then she would have been able to keep it all. And so this happens in the wealthiest families if the planning is not done properly. So really, this is about being smart, knowing what's potentially coming. And by the way, if it's not coming, even better.
Great,
right?
and then we prepared and we're good. That's right.
Even better. So that's I so believe in this strategy of knowing what's potentially coming, having that crystal ball by looking at other countries. And I have the benefit of coming from Germany where we're already ahead of that, where we're already seeing those things. Those loopholes, many of those loopholes are being closed right now because the country is aging and the retirement age in Germany was lifted to 67. The taxes were raised, the certain benefits were removed and so on. So it's what you're saying is not just likely, it's really inevitable, the degree of which can be discussed, but it is inevitable that we're going to go to that direction because no matter who wins in the elections, you can't run a country over decades with trillions of dollars of benefits. It will either lead to the implosion of the currency, right? In which case you will need to have hard assets anyway, right? And in which case gold and silver might be a good idea too. And or it will lead to these items have the raising of taxes. It's just natural. It just has to happen. We can put our head in the sand, or we can just say, okay, that's what's coming. What do I do? So I love your idea that you can build that parallel piece to it that you use to invest your pieces, but that also has a cash value for the multiple reasons that you mentioned. Yeah. Awesome. Is there anything else that you want to add to that?
I don't think so. I think we covered a lot, Jack. I think we covered a lot. Yeah. It's just be aware because people are just, if like a real estate developer, real estate investor, they might feel like they're tax bulletproof and they don't need any strategy or any planning. And I just wanted to really share with your audience, this is why it still applies to you and you really should care and you should be prepared.
Right. And this is not doom and gloom, guys, listening to this. This is like looking at the facts of demographics, saying, okay, the 30-year honeymoon that we had right now might last another 5 years, but at some point of time over the next 5 years, 10 the most, it's going to change. It's going to have to change. And as a result, let's plan for that now. And
Exactly.
the best way to plan it, as I always say, is both play offense and play defense. You can't win a football game if you just have offense, but you let the other guys run through your. You don't play defense. You can barely win a football game if you only play defense, right? That's what most people in jobs do. They play defense, like they sock away 5, 10, 15, 20% of their income, and they get just barely to the finish line with that in order to have some money on the sidelines that they can retire with.
Yeah.
The people who thrive in life are the ones that play offense by maximizing their income with land flipping, of course. That's what we propagate. And that also are aware of the taxation, optimize their structure for it in ways that gives them that income stream and those things that allow them to be safe and prosperous for the rest of their life. So that was an awesome session. Thank you very much, Rebecca, for coming on the show.
Thanks for having me, Jack. I really enjoyed it.
So with that said, I want to thank you again. I want to thank everyone for attending this session. Is there a way that people can find out more about you, Rebecca?
Yeah, basically, if you just Google my name, you'll find me all over. I do lots of media every week, but it's just Walser Wealth. So WALSER, walserwealth.com is our website.
Okay, walserwealth.com. Wonderful. So with that said, that concludes our show for the Forever Cash Life Real Estate Investment Podcast, where we talk about all things cash flow and building a life of cash flow, a life that is full of what we call forever cash that comes in forever. That's what we're all about. That's why we use our land flipping in order to create cash flow, in order to create wealth, in order to create cash, to roll into additional strategies. And this was a perfect session for that. So with that said, thank you very much, Rebecca. And everyone give us a 5-star review, give us a thumbs up, share this podcast with those around you that need to hear about this, and put the pedal to the metal. All right. Bye-bye, everyone. Thank you.
Enjoyed this episode? Then make sure you like, subscribe, and post your comments and questions below the video. We're looking forward to hearing from you.